A popular investment calculation is earnings per share, which is simply the company's earnings expressed on a per share basis. To calculate the ratio, the latest known earnings per year are divided by the number of shares outstanding. Here is the formula: earnings divided by the number of current shares outstanding. And here is the example. A corporation currently has 1,400,000 shares outstanding. The recently released annual earnings report showed a total of $962,000. What is the earnings per share? Let's see it on a spreadsheet. On a spreadsheet, enter the value of earnings, the number of common shares, and here is the formula: earnings divided by the number of common shares. And here the result is 69 cents earnings per share. The outcome in this example, or almost 70 cents per share, is valuable when a long-term earnings per share trend is studied. Most financial ratios are most revealing when you can see whether earnings are improving or declining over many years. The earnings per share is also used in a related formula that is widely used by investors, the price-earnings ratio. This is the price per share divided by earnings per share. And the example is, the price per share of stock in a company you are tracking is $35. The most recent earnings per share is $2. What is the price-earnings ratio? Let's see this example on a spreadsheet. Enter the price per share $35, earnings per share $2, and here is the formula: price per share divided by earnings per share, and it gives you 17.5 price per earnings ratio. To interpret the meaning of the price earnings ratio, the result, also called the multiple, is the number of years of earnings represented by the current price per share. In this example, the multiple of 17.5 is equal to 17 years and a half of earnings for the company, or simply stated, the number of years of earnings required to pay back the purchase price. The higher the price-earnings ratio, the greater the market risk. Though opinions vary, it is generally understood that a price-earnings ratio of 25 or below is considered a relatively safe investment, and price-per-earnings ratios over 25 are increasingly inflated in value. The price-earnings ratio is widely used as a means for comparing companies to one another or for tracking a company's market risk over many years. It is an especially valuable ratio because it combines a technical indicator, price, with a fundamental indicator, earnings. A potential problem, however, is a disparity of timing. If the earnings are based on those available 3 months ago, comparing the reported outcome to the current price could be unreliable or distorted. For this reason, the forward price per earnings ratio is often used in place of the more traditional ratio based on potentially outdated earnings. The forward price per earnings ratio is based on currently estimated or expected earnings per share. The formula is identical to that for price per earnings ratio. However, the expected earnings per share is used in place of the latest reported earnings.